What's up, traders? Welcome back to my channel. On Scale Effects in the building, back again to sharpen up your trading skill. Today we are breaking down one of the most misunderstood concepts in smart money trading, which is the concept of price mitigation. If this is your first time of viewing my content, kindly make sure you subscribe to this channel, share this video to more people so that you can also help the YouTube algorithm to recommend this video. Alright, so without wasting much time, let's dive into the topic as we learn on price mitigation and how we can actually use it to improve the chances of making profit in the market. So stay tuned, guys.
So guys, in order for you to understand this concept clearly, I will be giving the simplest explanation that you need to help you gain insight concerning this particular topic. Have you ever wondered why price tends to visit a particular level in the market and some of the supposed POI that we marked out are never visited? Have you ever wondered what is happening? These are some of the knowledge that the smart money traders or institutional traders have that help them to gain, a better edge in the market, that help them to actually make consistent profit in the market. There are a lot of confusing content out there that may actually complicate things for you, especially when you hear the word smart money trading, what it entails and how to go about it. So many people have different views about how this concept works, but you are supposed to keep it very, very simple and clear in order for you to avoid any sort of confusion whenever you approach the market. So what is price mitigation in trading? Price mitigation, by definition, is just the market way of revisiting a previous price level before continue in the desired direction. Now, what do you mean by this definition? Let's take, for example, suppose you have 2 point A and B. So this point A and B, let's assume that this is a particular train station, or whichever thing you can call it, like an airport or something. And the thing is, there are passengers in this particular point A. They're supposed to, a train is supposed to, move these passengers from here, point A to point B. Then what happened is they already have a fixed amount of people that this train are supposed to pick up from point A. For one reason or the other, this train moved from here and it was tending towards this direction. But the problem is most of the passengers are not yet filled. Price has not actually, the train has not packed all the passenger that is needed or board all the passenger that is needed. So what happened is this train will have to come back to this station to pick up the remaining passengers that are here before actually continue to this point B. Do you understand? So that is basically what price mitigation is. As at the time where price moved all the way from here, there are actually an order here that was not actually filled up. So what happened is price needs to come back to this point A again to actually pick up those orders before continue to this desired direction, which is what point B. So this is just the basic understanding of what mitigations are. And the reason why this is so is because if things like that are not identified in the market, or if the market decide not to work this way, there are going to be a lot of confusion and the forex market will be in shambles. For example, now when we talk about institutional traders, we are talking about the big, those that have higher percentage of moving what is happening in the market. They have the chances of moving price in the market, like the World Bank and so many big firms that you can think of. So these are the people we are referring to. Now, what happened is they are participating in this market and they have the capability to actually influence how price moved in the market. So if they want to place an order, they don't just open all their positions. Take for instance, the way you understand this is this: suppose you are a trader, you have the intention of making an entry from here, and your intention was to open like 10 positions. But what happened is, instead of opening the whole of that 10 position here, you decided to open like maybe 3 or 4, right? So that when price moved, and there is a possibility that price will retrace back, and when price come to this particular position again, you now intend to add like 4 or extra 5 position to make sure that your order, or what you intended to, the number of position you intended to open, are actually met, which is what 10. So this is actually how these institutional traders place their order. Because of the volume of money they control in the market, they are not allowed to actually place all their order at once. So what they do is they make a partial entry, and this is why I use the illustration of a train. They make a partial entry from here, and why price decided to move in their direction, they also have an unfilled order. So that means that they are expecting both sellers and buyers to actually participate in the market in order to balance the orders that are actually being placed in the market. Because if these things are not done, there's something they call institutional mitigation risk. And what this means is, if price do not move in this way, maybe those institutional traders, if they decide to place all their order, they will have what we call institutional mitigation risk. That means that there will be slippage. Price will not behave the way it should, because for price to be balanced, buyers and sellers are supposed to participate. But in a situation whereby a particular set of people now have the ability to push price to anywhere they like, it will not be okay for the market to actually move the way it should. So that is why price move the way they are. So it is very, very important that you understand this concept so that you will know when to be patient in the market. Price mitigation is one of the most important concepts that will help you gain a better edge in the market. Now, how do we go about it? How do we apply this knowledge on the chart? Suppose you have a trade entry to make. Suppose you have a trade entry to make. Let's assume this is our chart, and what you can say is price is creating series of lower lows and lower high, but something happened here. We have a sweep of this previous low, right? And then we have a break of structure to the upward direction, and that may signify a potential bullish move in the market. Now, many people are going to be making entry this level from this level, and especially this period that we've had a retracement, there are a set of persons that are going to be anticipating maybe a buy off from here. And one thing you need to understand is this is where price mitigation comes in. Now, market was trending towards the downward direction. For us to have a break of structure here after this previous low has been taken, that means that there have to be a sort of order block or something that was responsible for this break of structure. Yes, just like I give you an illustration that a train was supposed to move passenger from here to which is point A to point B. Now it picked some of the passenger and left some for whatsoever reason or the other. Now, on realizing that there are still people waiting for it for on realizing that there are still some on realizing that people are still waiting for it to pick up, he decided to come back to it. That means having that understanding means that whatever it is that was responsible for this break of structure, price needs to come back to visit this particular level. Now, why is price moving the way they move? Why is price acting this way? Number one, because there is an imbalance, or what some people call inefficiency. There's an inefficiency in the market, and market have to balance every order in the market. That is one reason. Secondly, to create what we call liquidity, because as we all know, liquidity is one thing that is actually moving price in the market. So based on this explanation, what is it that could be termed as liquidity? This is this thing right here, which you might call a higher low, is liquidity. Price needs to come and take it out, because that is the reason why this phenomenon is happening. Then the next thing is to actually avoid institutional mitigation risks. These are the three major reasons why this price mitigation or the smart money concept is very, very vital. These are the three major reasons. Number one, to avoid institutional mitigation risks. Number two, to create liquidity. Number three, to fill every order, or every unfilled order needs to be filled up. All right, so that is just it. Now, if you have that knowledge that this is just train has left some passengers here, and this train needs to come back here to pick up this passenger, you will not be quick to make your trade entry. You will be very, very patient, because the market can do something like this. The market can do something like this, and you might be thinking, oh, you're in profit, because you think these are W pattern, or what people call double top, and price will definitely come back to fill up this order. And this is when the smart money traders or the institutional traders are going to make their order. So they will enter from here, and what will they do? They will push price all the way to this particular high, which is what the point B. So I believe you guys understood what price mitigation is and you have a clearer understanding of it. I'm going to show you a chart example just to help you get this concept much more clear. Now, this is a chart of volatility 25-1x. All right. Now, the same explanation I gave you is the same thing that I'm just going to show you on the chart. Now, look at what happened here. Price was creating, let's just understand the structure from this level. You see, price was creating from this low to this high to a higher low to a higher high to a higher low to a higher high and all. Now, this was the last higher high that was created. That means that this particular high was taken. What happened? We had this break of structure, right? Price made a retracement and started trending towards the downward direction. Now, what we can see is the fact that, just use the explanation of a train, that for us to have this break of structure, that means that there was an intention. There are passengers here that a train was supposed to pick and then take to, let's say this is our point A and this is our point, maybe our point B is somewhere here. So price was supposed to actually take out these guys, right? It's supposed to pick up those passengers here and take it all the way down to point B. But what happened exactly? What happened is that when this incident happened here, it created this liquidity, because if you check here, there was an internal structure in between this level. Look at this. Let me mark it out. So this was actually a high, right? This wick was taken out. This week, this particular candle took it out. This particular candle right here took this high out. And what happened immediately? We had a break of structure still, if you want to look at it from this context. So we had a break of structure. And when price gave us a break of structure like this, I always tell you that it's not just one. This is one, and this is a major break, because from here, price was creating, you know, higher high, higher low, higher high, higher low. So we had this major break. Now, I told you that anytime we have a situations like this, it means that there are order, or people are moving from this point A down to point B. But most of the times, I don't know what the reasons are, but just like I've explained to you before, that if we are talking about the institutional trader, they don't place their order at once. But I'm using a more simpler analogy like the train or the bus. So they pick up these passengers here. They did not pick up the passengers, maybe because some of the passengers came late, and while they were moving, they give them a call that a particular passenger is already waiting, so they have to come all the way back. So anytime you see this type of thing happen, know that this particular candle, which is what, an order block, this is a bearish order block that is responsible for this incident. Price will definitely come back to visit it. So we are going to check whether price actually visited this level or not. So this is what happened. The train was moving, and it eventually decided to do what? To go back. Remember what I said, that these are passengers here that the market is actually trying to pick. Then it picked them from here, maybe because some of the passengers came late, it was not able to pick all the passengers. But on realizing that people are still waiting in that station, they have to actually go back. And you see that price eventually tapped into it. Now remember the three reasons I gave you. Number one, to avoid institutional mitigation risk, which is why I told you that the institutional traders, which are the big firm, they don't place their order once. They place it, at an interval. So they will place some while the trade is moving. They know that the seller needs to participate, so that every imbalances in the market, every imbalances in the market will be balanced, or what people call fair value gap or inefficiency. So, and they will have to create what? Liquidity. That is the reason why this phenomenon is very important. Now, this thing here is serving as my liquidity. And what happened? Price eventually come back to this order, pick the balance every imbalance, and pick the remaining passenger from this point A, and you see this massive drop. You see this massive drop. Now this is the same thing that I'm saying here, because I need to be very, very patient. If price is supposed to push all the way up, now I've seen that there was a previous low here that was created, right? Price actually price was creating lower lows and lower high, right? Lower low, lower high, lower low, lower high, lower low. So after this break of this low was taken out, what do we have? We have a break. We have a break to the upside. This is a break of structure. Now what happened is price eventually come back to actually create some sort of liquidity here. Now remember what I told you, that anytime we have a phenomenon like this, there is always one candle that is responsible for that break. So, and price needs to come back to actually tap into this order block, this particular candle, which is like, as I said, that the train needs to come back to pick the remaining passenger. And this is how the institution understand how orders are being placed in the market. This is how they place their order. So you as a retail trader, it is always important that you pay attention to this phenomenon. Be patient enough. I am not in rush, because all these things here are liquidity. If price will tend to push this high, there is always tendency that it will come back to actual, because this thing you're seeing here, these are all imbalances. These are inefficiencies that price needs to fill up. So that means the price will still need to come all the way here to mitigate this, and then we have our conservative entry and expect price to push all the way high. I don't want to make this video very lengthy. I believe you understood and you've learned something very, very important. You want to trade like a professional. All right, so in the link of I mean in the description of this video, there is a link to our Telegram channel. You can actually join. We host free live classes and drop free signals there. All right, so you can join the Telegram channel using the link in the description of this video. And if this is your first time of viewing my content, please kindly make sure you subscribe to the channel and share this video to others. Like and comment if there is any video you want me to make. You can also always drop it in the comment section. I always check my comments to see what you guys are saying and see how I can actually serve you better. So this is where we'll be stopping. Hope to see you in our next video, where we'll be doing more of a top-down analysis. So peace out, guys, and see you in our next video.